Today we'll review the investment risk, merits, and valuation of Family Dollar stores. Our review of Family Dollar stores begins with a story of sevens. The company operates over 7,500 stores at about 7,500 square feet, roughly 7 miles away from their target demographic that makes less than $70,000 a year. After the recent takeover attempt by the Triumph Fund in 2011, the fund's CIO, Edward Garden, was added to the board of directors, and the company's balance sheet was recapitalized to 70% debt to equity in efforts to leverage shareholder returns. More recently, Family Dollar has concentrated on their consumables category. This category has gained product mix share over the last decade of over 17% and currently makes up 70% of their product mix. It's important to note that these categories offer significantly more trips to the store, but significantly lower margins than these other categories. We'd also like to point out that recent changes in analyst recommendations in the stock have been downgraded.
Currently, one of Family Dollar's primary initiatives is to increase the number of stores they operate. Now, this growth will be primarily focused out west and will be partially funded through their sale-leaseback program. Also, their 2 new distribution centers, one in Utah and one in Indiana, will help facilitate this growth, while the distribution center in Utah, pointed in blue, when it becomes operational this summer, will improve operating efficiencies by reducing the cost of transporting goods to the stores and services. In addition, Family Dollar has engaged in store renovations. These renovations include changing the layout of the store, adding coolers, and takes about a week for them to implement these renovations while the store is operational. These renovations boost income of the store by about 10% by improving operational efficiencies and enhancing the customer experience. Collectively, these tactics will cause margin pressures in the near term. However, in the long run, when these assets are fully leveraged, Family Dollar should experience greater returns.
As you can see here, Family Dollar has recently moved to a 70% liabilities, 30% equity structure. This includes a recent issuance of $300 million in public debt to finance their stock repurchasing initiative. This is the second long-term debt issuance by Family Dollar since 2005, but the first public debt offering in the company's history. This capital structure was designed to maintain the company's investment grade rating, although it is at the lower cusp of that range. This change in capital structure coincides with a drastic change in their management. Now, the Levine family represented over 100 years of family management in the old business model. However, there are some concerns regarding the new management team. Family Dollar has strategically acquired new members with the same type of business style as Family Dollar is going through right now to facilitate their store growth efforts as well as consumable goods offerings. Now, this management team does show a willingness to adapt, but with an average tenure of only 1 year, their capabilities in this changing business environment remain to be seen. This is vital, especially where Family Dollar lies within the business life cycle. Now, Family Dollar had previously been in the maturity phase. They have re-emerged in the secondary growth stage due to their drastic expansionary phase. They expect from the current store growth rate that they will re-enter based on investor guidance during the 2025 year into the second maturity phase. This is crucial due to EPS as well as revenue growth. Now, EPS growth over the last 5 years has been 15 to 20%. This is primarily due to their share repurchase initiative, not due to increased profit margins. Revenue growth over the last few quarters has been 12%. This is mainly due to their expansion out west, as well as new stores in their already growing markets. Family Dollar cannot sustain a 12% revenue growth year over year, so we expect them to step down to historical average of 8.5% by mid-fiscal year 2014.
In our estimation approach, we considered 5 different methodologies: the price to book, price to earnings, the dividend discount model, discounted cash flows, and an exit multiple approach. The exit multiple approach yielded the highest price target of about $71. However, the recent attempt by the Triumph Fund to take Family Dollar private was met with significant shareholder resistance, and a subsequent poison pill provision was enacted. As such, we did not believe using an exit multiple was appropriate for Family Dollar, and its weighting was reduced to 0. Next, we have the price ratio valuations. Price to earnings and price to book for Family Dollar have very strong peer comparisons. In addition, the historical values of price to earnings and price to book also exhibit a fair amount of stability. The price to earnings over the last couple of years, from 2011 through late 2012, has been elevated. This is likely a market response to the recapitalization efforts, the try and fund attempt, and the buyouts that have been announced recently. Because of the relative stability of these ratios, we assign a very high weighting in our valuation. Next, we have the dividend discount model. Family Dollar has paid dividends consistently on a quarterly basis for the last 20 years. As such, this is a very appealing approach to value Family Dollar stock. However, the share repurchases and recapitalization make estimates of dividends per share unstable. As a result, we lowered the weighting of this in our final price estimate. Finally, we have the discounted cash flow methodology. Family Dollar's cash flows from operations have been stable and positive and growing at a consistent rate for years. However, their aggressive expansion plans out west and existing markets make cash flows in coming quarters and years unstable. The CapEx cash outflows drive total cash flows to the firm to be very low, likely through fiscal 2014. As a result, we lowered the weighting on this valuation as well. In addition, their changing capital structure places significant volatility and uncertainty regarding their weighted average cost of capital. If Family Dollar increases their leverage too quickly, this could cause the costs of both debt and equity to rise appreciably. Our weighting valuations for our price estimate are justified given the relative risks and benefits of each of the valuation approaches. It should be noted that even though the exit multiple did result in a $71 price estimate, a simple average across all of the valuation approaches would still result in a hold rate.
Now we're going to talk about some of the investment risks that Family Dollar faces. We have them plotted by the likelihood of their occurrence and their impact to the line of business, beginning with consumer relevance. We mentioned consumer relevance earlier, and that Family Dollar has made significant efforts to build new stores, renovate old ones, and to pair its SKU assortment in ways that appeal to the trade-down consumer. As their demographic shifts to the trade-down consumer, Family Dollar risks missing its mark and becoming less relevant. We also discussed earlier that these events coincide with a strategic shift for the firm in which new customers are being targeted, new financing methods are being explored, and the capital structure is changing. Family Dollar management also leans heavily toward the value chain background that the firm is moving away from. Macroeconomic factors are common to all firms. However, Family Dollar is unique in that its traditionally counter-cyclical business model is being altered by the aforementioned strategic shift. Coupled with political and economic uncertainty, we believe a high probability exists that a moderate impact occurs to business due to macroeconomic factors. The firm's recent strategic partnership with McLean presents risk of fulfillment and litigation. Additionally, the firm's direct global sourcing initiative presents international risk to the firm. Family Dollar faces heavy competition, not just from Dollar General and Dollar Tree, but also from grocery stores and from pharmacies. As the company shifts to a trade-down focus, its competition will include a higher echelon of retailers, including Target. We also discussed earlier that in the long term, Family Dollar has indicated that it's bringing to market high-margin private label goods. But in order to increase market share, the firm's short-term strategy is to sell low-margin products such as national brands and tobacco in order to increase traffic. The firm has indicated that these efforts have thus far been successful, but has also cited higher than expected margin pressure. It should also be noted that the company is subject to litigation risk from investors, as noted by the class action lawsuit filed yesterday. In conclusion, we're recommending that investors hold their positions in Family Dollar with a target price of $54.29. We find the company to be an exciting and evolving brand with strong fundamentals. However, given uncertainty surrounding recent changes in the firm, we believe that better opportunities exist for investors looking to initiate a position. Thank you for your time. We'd be happy to take your questions.
You have a 12% EPS growth rate for the next 5 years, but you didn't spend a lot of time in the presentation on how they get to a 5% growth rate. So could you start with sales and kind of walk us through the various earnings growth drivers?
Yeah, so one of the primary initiatives is to increase the number of stores that they operate. This is going to increase revenue year over year. I think they have about an average historical growth rate of about 4% in same sales stores, and they're planning on growing their stores by about 6%. Collectively, these initiatives, according to financial analysis that we've done on them, leads to about an 8.6% growth.
In addition, they did issue a notice that they will be doing more share repurchases. These are yet to be completed. They will be completed, expected to be completed in the next 2 years. That's going to help drive earnings per share growth. So we did assume fairly conservative macroeconomic assumptions, about a 2.5% inflation rate, 1.5% real GDP growth rate. We feel those are probably best suited during the current environment, and given the demographics of the way the U.S. market is, probably appropriate going forward. As a result, the estimates for future growth for the next, as my colleague stated earlier, we expect that they're going to have about 8.5% growth through about 2025, which is when they should revert back towards a more mature phase, about 5%, 4 to 5% growth rate. Significant impacts from government regulation and taxes, as we've seen over the last few months, like the payroll tax expiration, do have a significant impact. It's uncertain as to how much that impact is going to remain throughout the next year, although early indications are it will be there. If that becomes worse, then obviously that would cause a downturn.
Thanks for going over. You've got a cost of equity of 7.9% and a terminal growth rate of 4 on free cash. So that leaves us with about a 33 multiple on free cash flow in 2018. Can you explain theoretically? That's right? I mean, you should have.
Yeah, for our performance.
So can you explain why not that makes sense relative to CapEx and depreciation? You pay a lot for free cash flow, if that's a run rate number.
Yes. So the cost of capital, because they're BBB rated and their use of leverage, we kept it high. Their equity structure has been made to reduce it, but not materially. Their exit multiple that so you're using the enterprise value exit multiple, or?
Typically, if you've got a perpetuity growth rate and a cost of capital, correct me if I'm wrong,
The perpetuity cash flow, yes.
that's going to be a multiple, right?
Yes. That is what we use.
And so your cash, so what I'm trying to understand is, what's the free cash flow on maintenance mode here, and what multiple are you paying on kind of a real terminal growth rate? Because I don't think you got the terminal growth rate of the business.
Okay. Well, we have our CapEx, maintenance CapEx is closer to about 3% of their revenues. Historically speaking, that's about in line. But
The exit multiple we used for the free cash flow was 8.4 as a terminal growth rate. This is in line generally with the acquisition. We looked at what the Triumph wanted to acquire Family Dollar for, and that's what the offering was for, with the 8.4 exit multiple. They're not generally a target as a takeover, although Dollar Tree, a general competitor for them, had been taken private and then had been taken public again. Although 8.4 is expected, we can use a different growth rate, but we found that most suited for the industry that we're in and the other competitors that have seen firms taken private, as well as the Triumph one that's having a takeover Family Dollar.
I don't want to think
Just to
about
add-
8.4 that's a multiple EBITDA.
That's right.
Okay.
But to get back to the cash flow issue, yes, 4% may be a little bit on the low side, but it's conservative. And for this case, I believe, we chose to take a conservative approach with their revenue growth in the future and dividend growth. And actually, dividend growth at a longer run base should be about that as well. But as I mentioned earlier about the macroeconomic risks and factors, a 4% growth rate obviously would be impacted significantly if inflation were to be realized higher. Obviously, what's going on economically, that could happen. That's a potential upside risk to our growth rate.
Let's move on.
I'm concerned about the debt, 7% debt. Can you tell me anything about the debt structure in terms of the maturity of the debt that they owe and how, what kinds of debt they have?
So,
Sure. They do have $600 million in long-term debt, $300 million in privately issued debt, and $300 million in publicly issued debt in 2010. Now, the privately issued debt does have a sinking fund provision in it. They do make payments month by month. But the publicly issued debt two revolvers. They have a $300 million short-term liability revolver and a $400 million short-term revolver as well. They're using these revolvers to fund the lease buyback programs that they're doing, as well as the debt that they've taken on by the long-term debts. They are only using that to facilitate the share repurchase initiative. In addition to that, investor relations guidance states that management will continue to use fund debt to keep EPS over at least 10% in double digits during the growth phase. So we can expect them to even leverage higher, although we do expect return on the lease buyback to be realized in about 2 years once these stores are completed and they are leased back or after being sold.
Would you address their competitive posture in one more detail in your presentation did in terms of who else are they competing with, what are the differences, and what kind of headwinds do they all face in the near term?
The primary competitors are Dollar General and Dollar Tree stores. As they transition into a category with more consumable mixes, they will face some pressures from the Walmart Expresses that are being built in some of the CVS drugstores and local neighborhood markets. As they bring on more consumables and more refrigerator doors that they're currently adding, they will have to compete with some of the more local Stop and Shops. The large thing that they have to deal with from a competition basis is the fact that there are a large number of competitors in the consumables markets that are local to the neighborhoods. They will have to face a lot of margin pressure. It will be very important for them to be able to bring nationally recognized brands into their stores to attract customers, but then to be able to convert them to the private label brands that they've been globally sourcing so they can bring the margins back in line with where they can become profitable. So that'll be key for them to be able to do that. They need to be able to attract the $40,000 to $70,000 a year customer away from what they're calling their trade down customer from the middle class, and attracting them via national brands and converting them will be the most key thing that they need to do.
It looks like in your projections you have pretty stable margins. What are the drivers that will either increase or decrease the margins of the company?
The main drivers of margin are going to be their ability to convert their new trade down customer and their current customers to the products that they're sourcing as private label. So they've worked with the distributors that they have, like McLean, to be able to source private brands for them. But they've also set up offices overseas to be able to directly source these programs, which is growing significantly in the company right now, to be able to bring those margins back in line with where they need to be. So the key things will be to be able to attract customers that buy products and buy consumables that bring larger tickets per store, and then to be able to convert them into their private label brands that they actually make.
Just to add to that, in their most recent quarterly results, they did cite they were having margin pressures, but their relationship with McLean offset those. So that kind of displays this difficulty with trying to project margins going forward because they have a lot of offsetting parts of the business right now.
Why value retailer on price to book? I know it's been stable, but I'm trying to understand the theory of why we use price to book for retailer.
The main reason that we chose to use price to book is because when you use a dividend discount model, the significant amount of share repurchases they've done recently alters our dividend discount model, and it really can mess with the assumptions that we're going to base our dividend discount model on. Furthermore, with the cash flow model, it does create more unstable free cash flows, and even more recently, some of their cash flows have actually been to the negative side. So over a long period of history, Family Dollar has done a very good job of producing free cash flow to the firm, but more recently with their extension and expansion, they've not been able to do that. So we wanted to kick back and find a very good way to value the company relative to their peers who are very similar to themselves and operate very similarly. They have very similar capital structures and they operate in the same markets, attracting the same customers.
So